Hi, this is Eric Schleien. You are listening to the Intelligent Investing Podcast. We have Jeremy Raper back on. Jeremy, how you been? Happy New
Hey
Year.
Eric, how are you? Happy New Year. Nice to be back.
Yeah, it's great to have you back. So,
Thank
so
you.
it's
Thanks
always
for having
interesting to talk to you. So I'm excited to see where we get into in the conversation tonight.
me. Yeah. I mean, it's been a few months. I mean, I was just looking through my past appearances, and I realized maybe not the first appearance, actually, the second appearance was basically right in the peak of the Corona crisis
Mm-hmm.
in mid-March.
Yeah.
And yeah, I think what I said at that time was basically, look, a lot of these companies, they're going to go through a really rough time, and a lot of them aren't going to make it. But basically, all these companies are priced for destruction. So if they don't disappear, then they're multi-baggers, right? And look, we went through a fair few of them at the time, so I don't need to do the full recap.
Yeah.
But almost a year later, not quite a year later, 10 months later, that's kind of what happened, right? Like the market threw a huge number of babies out with the bathwater. Frankly, a lot of the stuff that I thought would disappear and file managed to get by thanks to the Fed. And those turned into 10 baggers. But even the more respectable things like the air caps, some of the airline related, not airline, but aircraft financing, let's say, and some of the aerospace supply chain names, these have all done very, very well. And so now we're kind of entering a new phase where the quote unquote easy money has been made. Basically, everyone I follow on Twitter has been putting up these crazy returns for 2020, which is always pretty scary.
Yeah.
And I think it's going to be a much more difficult environment this year, frankly, than last year. Even though the Fed's still there and accommodative, and now it looks like the Democrats are going to have both houses of Parliament in the US. So the environment will remain accommodative, but the returns will be harder to find, which is fine. You're never gonna, I mean, never say never, but 2020 from investors' standpoint is kind of a once in a lifetime type year.
It was a wacky opportunity.
I mean, look, it was a wacky opportunity. It was the most difficult thing. I've been talking to a few people about getting through 2020, and like, if you remember in late February, early March. The problem is most crises, they unfold at a certain pace. So like if you think about the financial crisis, the market peaked, well, the mortgage market blew up in the summer of 2007. And I remember it distinctly because I was an intern on a credit desk in Tokyo, and all of a sudden the head of the desk ran on the trading floor at 9 a.m. one morning saying, "Why didn't you sell all this paper? I told you to sell all this paper yesterday." And that was code for they were taking a huge loss on some mortgage bonds. Anyway, so that was memorable. But the point is that blew up in 2007. The market didn't blow up until mid 2008, late 2008, right? So it had a year of translating those mortgage losses throughout the financial system. And even when the market blew up in October 2008, it was kind of it wasn't quite a slow motion blow up because there were days like we had in March, but it was a much slower motion blow up than
Yeah.
March. So in March, you had this incredible intensity of pain. And so like take AirCap, stock that I own, one of my largest conviction longs at the time, right? The problem was if you're making an investment decision, it's very rare that you're forced to a decision to enter or exit a position within a matter of days, right? For a professional investor. Most of the time you'll look, the stock might go up or down 5-10%, might even go down up or down 10-15%, but it's not like it's moving 60-70% of its value in days, right?
Do you remember us joking around? I don't even know if it was recorded or offline, but I think I said to you, I was like, I buy AirCap, I wake up the next day, it's down another 30%.
Yeah, I think I don't. Yeah, and you weren't joking. Like,
I
so
know. It's like, where'd the
I,
money just go?
I pull up a chart at the end of January. AirCap was like making new highs, $65. By mid-February, it was down to the mid-50s or whatever. So it was down a little bit. I don't know. Corona was spreading throughout China, but within the last week of February to the middle of March, so
It was
within
like
a
18 or something, right?
bottomed at 10,
Did
within
it
basically
bottom at
15
10?
trading
Really?
days, bottomed at like 10 or 11.
Oh,
So
wow.
I
Okay.
mean, there are tons of stocks like this, by the way. There are tons of stocks like this, but essentially you had anything travel related lost 75% of its value in basically 2 weeks of trading. So 10, 11 trading days. So maybe 3 time weeks, but basically 2 trading weeks. And so the difficulty there is you can say you're a long-term investor, you can say you understand the story, but it's really hard. Like, there were a couple of guys on Twitter saying pound the table buy. not many. I think Cuppy was one of them. One of my buddies in Singapore was pretty aggressively getting long. You know, I was like dipping my toes in. I was like trying to add here and there where I thought it was just silly prices, but it's not like I didn't mortgage my house, sell my kids to get long in the stock market in March. So it's very difficult when prices move that quickly, right? So if I kind of cast back on what I did, I wasn't super happy with how I traded in March, but the rest of the year I feel like I did a lot better, right? So once things had stabilized, even at much higher prices, right? So once you knew the Fed was kind of there and that liquidity was just going to be endless and basically pumped into the system, not as it was needed, but many times over what was ultimately needed, right? They fully backstopped the credit market. You know, once that became apparent, then you kind of had a green light, or you should have been aware you had a green light to really kind of get a bit longer. So that was 2020. That's all hindsight. I mean, I think the playbook for this year is quite a bit different, frankly. So, I mean, just to kind of outline how I'm thinking about it a little bit, right? So most of what has worked very, very well in the last, like, call it 10 years, but particularly the last 4 or 5 years has been massive long growth, short value, long compounders, long bond substitutes. So anything with kind of like a perceived terminal growth rate above the long-term bond yield, which is steadily compressed, has been trading at a huge premium. So everything from, you know, tech compounder stocks to SaaS stocks, you know, where the perceived back end payoff in 10, 15 years is much higher than the payoff today. All these stocks have been massively rewarded by lower interest rates, by the compression of the cost of money. None of this is rocket science. The problem is inflation is everywhere, increasingly everywhere. And so if you take that, so let's frame it another way. Like, a lot of people think they're, you know, let's say they go out and they buy Salesforce.com or Adobe or, I don't know, DocuSign, or not Zoom, because, you know, these kind of things are explicit COVID beneficiaries. I'm just talking a run-of-the-mill, pretty high quality software company trading at an insane valuation. There's hundreds of these things. Yeah. They think they're making a stock specific bet. So they think they're making an idiosyncratic bet, but they're not. They're actually making an interest rates bet. That's all they're doing. They're making a style bet. So that's all well and good when it's working, and when momentum, that's the momentum factor. But if momentum changes, and then, you know, inflation related stocks, commodities, whatever, then that gets the momentum factor, and people are actively looking for more, you know, inflation hedges, inflation related plays, or God forbid they start looking more at value stocks, then it quickly turns into a steamroller. And, you know, so it's kind of what happened a little bit in 2000. Obviously in 2000 there was a massive tech blow off and a crash. But I think that year the Dow Jones is actually up. So, you know, I'm not calling for a tech crash or anything like that. I'm saying, if you're long these kinds of massive secular winners that have done great for you, not just last year, but the last, you know, 4 or 5 years, it seems like a terrible risk reward. And I say that because inflation is apparent everywhere. Look at lumber prices, look at container ship rates, look at, you know, agriculture prices. Basically any agriculture crop you look at is at a multi-year high. Look at iron ore prices. Iron ore prices are at all-time highs. Look at coal prices. They're ripping off the bottom. They're quickly rallying back. Copper is in deficit. Aluminium's at multi-year highs. Copper's at multi-year highs. Oil-related, like, derivatives like plastics, ethylene, PVC. You know, oil is still at $50, but, you know, some of these oil derivatives are starting to rally kind of aggressively. So, like, you know, when the price of everything is going up, it does seem more likely that inflation will take hold. And now you have a Democratic administration that, frankly, they wanted to hand out free money to everyone before, and Republicans kind of got on board last year post-COVID, but there's no reason for them to hold back now, right? Why wouldn't there just be massive fiscal stimulus in addition to the monetary stimulus? So, like, you know, if the value of the US dollar is going down, then inflation in some form or other is going to be, you know, the 10-year yield has started to move, right? So, look, I kind of think it's very dangerous to be wrong what worked last year. That's not to say the businesses can't keep performing. So, like, I own a fair few things that did very well through the pandemic because they were, like, you know, financial services related businesses that do big, you know, a lot of trading or whatever, right? So stock trading has been high. I think it stayed high.
Is my dog very loud on the mic? Is it picking up?
I mean, I can hear him.
Yeah, he just discovered his reflection today. So
Okay.
hold on one
I
second.
guess he likes inflation stories.
I guess so, buddy. Hold on one sec.
Okay, no worries. All good.
All right, we'll see.
So basically, what I'm trying to say is, it's not like I've thrown out all my, favorites or whatever from last year, but where I am sticking around in names that were COVID beneficiaries, they have to show two things. One is they have to be maybe positive beneficiaries of inflation, right? So I'm long a company called StoneX, SNEX, which I've talked about elsewhere in the public domain. They're a beneficiary of higher volatility, higher capital markets volatility, higher soft commodity price volatility. They basically do a bunch. They're a financial intermediary for a bunch of different kind of off the run markets. So ags, soft commodities, hard commodities, bullion hedging. They have a small payments business. They do OTC clearing. They do ADR trading. But they have a very large float as well, right? Because they custodian for a number of accounts. So their float is like $5 billion. So obviously if interest rates go from 1% to 2%, that drops straight to the bottom line. So yes, they were a big beneficiary from the jump in vol last year. I think that probably continues. Look at what happened on Capitol Hill today. But even if that doesn't continue, or not to the same extent, if rates go from 1% to 2%, they're minting it. So these kinds of trades where they're positive beneficiaries of a more inflationary environment or a normalization in the yield curve. And then obviously I still have some stocks that did quite well last year, where more idiosyncratic stories like related to online gambling transition or whatever, but they're on, let's say, a shorter leash, some of them, than some of the other stuff that I'm trying to put in the book, which is much more explicitly commodity related. So like a lot of the stuff I'm looking at now is like, somewhat idiosyncratic junior Canadian copper miner or whatever, trading at 3 times cash flow, even if copper goes down 40% kind of thing. And copper's at multi-year high. So if copper stays here, it's at like 1.5 times free cash flow or whatever, right? So things like that, like a little bit junky, a little bit off the run, but huge beneficiaries of a more inflationary commodity price environment. So I'm looking at a few things like that, and then the other stuff is a bunch of special sit stuff, which is a bit more independent of the broader macro environment. So like ARB related trades. So like, I'm not sure if you got involved last year, but there was a lot of action in the SPAC warrant ARBs.
Mm-hmm.
You know what these are?
Mm-hmm. Why don't you explain to listeners what they are, though?
Well, like, so everyone knows what a SPAC is at this point, but essentially the way SPACs get financed is they say, look, buy our SPAC, give us a bunch of money, we'll find a deal in a year, 6 months to a year, or maybe even 2 years. Give us a bunch of money. In return, you have the right to put back the money to us before the deal gets, when you vote on the deal, you don't like it, you can get, put back the shares and we'll give you whatever you gave us plus the accrued interest, essentially, which is essentially a treasury bond type yield, right?
Yeah.
Now, to sweeten the deal somewhat, we'll also give you a warrant, which is just a 5-year option on the underlying stock. If it goes up, generally it's 15% in the money. The warrant is struck 15% above $10, so $11.50. So it's like a little kicker if the stock actually performs. Now, because the market is insane and everything's going up, a lot of these SPACs, the stock prices have taken off. And so the warrants are extremely deep in the money, right? So if the stock was priced at $10 and then it's a hot deal and the stock's trading at $25, it's extremely likely the warrant's going to be in the money. So if you think about the way option pricing works, right? So not to get too technical, but basically these warrants
you can get very technical. It's okay.
They're 5-year options, right? For most of them, and the strike price is $11.50, and you can generally convert, or the company can force conversion above $18. So if the stock is deep in the money, the company can force conversion. Now there's a few wrinkles which I'll cover, but essentially after $18, if in that scenario where the company forces conversion, the economic payoff of owning that warrant is almost identical to owning the stock, right? So if the stock, let's put it this way, if the stock is $30, right, and you own an $11.50 warrant, if the stock goes from $30 to $20, obviously if you own the stock, you would lose $10 a share. Similarly, if the stock went from if you own the warrant and the stock went from $30 to $20, most likely you would lose $10 a share. It's not Not entirely true because there's a small time value
Sure,
component
yeah.
left. But almost all the value of the option of the warrant is then intrinsic value, right? The difference between the stock price and the strike price. So if the stock's at $30, most all states of the world, you would expect the warrant to trade close to 30 minus 11.5. That's intrinsic value, right? Which is what? Often it's 1850. Math is not my major. So you have all these situations.
Makes two of us, by the way.
Where you have all these situations where deep in the money SPAC warrants are trading way below intrinsic value. Way below intrinsic value. It's not something you see every day. So basically, I mean, you could pull up some of these things, but there were a few egregious examples in the very recent past. None, by the way, I have no positions in any of these right now, but I was involved in a few of these trades last year. So one good example last year was the Hylion, HYLN, warrant, SPAC versus warrant. That thing blew out and then ultimately collapsed very close to zero. Maybe it's still around, I'm not sure, but it blew out then collapsed. Nikola was a big example. Nikola, that warrant spread blew out to 20 bucks. And when I say spread, I mean the spread versus intrinsic value. So
yeah,
stock was trading at a huge premium. Sorry, the warrant was trading at a huge discount to intrinsic value, $20 discount, which is fairly crazy if you think about it, right? If the stock's at 40 bucks and the intrinsic value of the warrant is therefore $29.50 and the warrant's trading at like 10 bucks.
Yeah.
I mean, these things are unheard of.
So were you buying the warrants and then shorting the
Yeah. So the way you would exercise it, so this is where it gets complicated, but essentially there's two things. One, you need to have borrow in the stock. Okay. So if there's no borrow in the stock, then there's no true arb because you can't hedge the stock. You could go into the options market and try and hedge that way by selling calls, like selling a similar strike call or whatever. But again, without borrow, the options markets also depend on borrow because the way an options dealer will hedge their ability to sell you an option or buy an option is by then shorting or buying the underlying stock. So it still comes down to the same thing. So because a lot of these SPACs are relatively tight floats and a lot of the shares are locked up, the borrow markets can be very volatile. That said, a lot of these things did have borrow, and even if the borrow is 15-20% cost, 15-20% a year doesn't really matter if the spread's 20 bucks, right? Let's be honest. If you're making, if you're going to hold this thing for 3 to 6 months and you're paying 20% for your borrow, that means you're paying 10%. Well, 10% of 20 bucks is $2, right? And if the spread's $20, you'll pay that all day and twice on Sundays.
Yeah.
So if the borrow is there, it doesn't really matter if it's expensive. The risk is not the cost of the borrow, really. The risk is losing the borrow, right? If you just, too many people put on this trade, you can't close the arb, you get squeezed out, and that's how these spreads started to go vertical. So basically what happened was all these idiots buying these stocks are Robinhood punters who don't know what a warrant is and or can't trade a warrant. Or
what do you call them? Robinhood punters?
Punters, yeah. Punters like gambler, like
okay.
Speculators. The speculators is too nice a word for these people, right? They woke up yesterday, decided they wanted to invest in the stock market.
Right.
Frankly, look, God bless them, whatever, but you know, they're trading.
I was just on a podcast that came out today and I was just talking about this.
Well, they're trading sophisticated financial instruments and they're doing it on their smartphone for no cost. It's a recipe for disaster in the longer term, and they're getting rich now. So
especially if they do well now.
Dude, there's a great Twitter follow. I highly recommend everyone follow this Twitter account. It's @TikTok Investors.
Okay.
And it's like the bag holder quotes, but for TikTok. Like there's all these people on TikTok who say things like, "Hey, if you had bought Square shares a year ago, you'd be up 10x. Put your stimulus money in Tesla calls. You can make 20 times." You know, like these kind of crazy, and it's some cute blonde in a MAGA hat or whatever, right? So it's a hilarious account.
That's awesome.
Everyone follows it. But look, the serious point is they're speculating in sophisticated, complex, and highly risky financial instruments, and they really have no idea what they're doing. But the upshot is the stock price tends to diverge wildly from the warrant price.
Yeah.
So basically, if you can hold this arb, if you can hold it to conclusion, you will make money. Now there is a wrinkle other than the borrow wrinkle. That's wrinkle number one. The other wrinkle is these warrants are not a typical option, right? So your typical option is either European style, which means it exercises at the maturity of the option, right? So if it's a 1-year option, you can exercise it at day 365 and not earlier. or the typical ones that get traded in the US are American style. So you can exercise them anytime. So obviously as American style options, if it was $10 in the money, you just exercise it immediately, collapse the warrant and take your money. But these warrants are not exercisable until the later of, typically, this is a typical situation that the terms do change. They're not exercisable until the later of 1 year after the IPO of the SPAC, or 30, I think it's 30 days after the closure of the business combination. So this is where it gets confusing. You have a bunch of SPACs, right? All of these SPACs are new SPACs. They've all launched in the last 12 months, most of them in the last 6 months. Even if they find a deal, and that's a hot deal, and even if that deal closes in 3 months, right? So let's say you put on this ARB, it's a great ARB, super juicy. You wait 3 months, the deal closes, boom, you're like, okay, sweet, I can collapse it, I can exercise. No, that's not the case. The warrants stay outstanding for at least a year. And that's how some people got burnt in some of these trades, because they assumed after the deal closed, well, that's it, the SEC will automatically, register the shares under the warrants, and then I could just convert, easy peasy. Actually, no, you get into these trades, you might have to be able to hold them for a year. So that's the issue. When you're looking at these warrant ARBs, they can be very juicy, but you want to look at ones where they're what's called seasoned SPAC IPOs. Seasoned meaning the shares have already been outstanding for a year or almost a year, meaning the only thing that needs to happen for those shares for the warrants to become exercisable is they need to just close the deal. So when you're an ARB, you're really trying to handicap what can go wrong. Most of the time, things go wrong when you stay in positions for a long time, right? The longer you're in the trade, the more likely it is that more people put on the trade, that borrow gets tight, that the company comes out with some crazy announcement, gets all the bulls excited, whatever. So basically what I did last year is I tried to focus on ones where there's a very tight timeline to closure. So yeah, the spread might not have been $20. Maybe the spread was only a few dollars, $4, but I knew that I only have to wait 30 days.
You were taking a lot of the risk off the table.
Yeah, I was accepting a lower return with lower risk. Yeah. So basically, on a risk-adjusted basis, I thought it was a much better bet. And so that's why I've stayed away from some of these crazy ones at the end of last year, like QS. Look up QS or SPE, anything EV related. These warrant spreads just exploded. And a lot of friends in them who unfortunately have lost money. And they may end up being fine. They may end up making money if they stay in the trades, but it's a tough way to make money.
Yeah.
So basically, I just have a little calendar where I look at, okay, what's the timeline to 1, the deal being seasoned, in other words, the 12-month period, and then 2, the deal closing. And so for some of those, the warrant spreads will compress to $2 or whatever, but even so, $2 on a $11 warrant, whatever, is like 20-25% return. But again, you don't have to post all the collateral, so the return on capital can be extremely high. So that's kind of an interesting special situations area that will remain interesting as long as Robinhood punters remain crazy, and as long as they remain unsophisticated. Both propositions of which I'm extremely
high probability.
Yeah, exactly.
Are there any particular names that you're willing to talk about that you think are interesting?
There's lots of names that I think are interesting.
Mm-hmm.
I have the highest conviction idea I've probably had in a long time. Definitely at least the last 6 months, probably all of 2020. Unfortunately, I had just wrote it up for my subscribers, so I'm not really able to unpack it with you at this stage.
But if they want to see it, they can subscribe to your newsletter.
Yeah, this is not really intended to be a pitch, but
I get it.
Obviously,
I think you offer a lot of value, so it's worth sharing your newsletter, and people register for it. So
thanks, man. Yeah. So if they really want to look into that, that's rapercapital.com. They can check that out. But look, other than that, I mean, look, there's definitely a lot to do. So yeah, what can we talk about that's super interesting?
If you're an investor, what areas do you think you'd start looking at in terms of research process?
You mean just for a new investor, or
no, someone who's a seasoned investor and they're like, what are maybe some interesting things, parts of the market to start researching? Where would you be spending your time?
That's easy. Oil and gas.
Okay.
Energy. So look, okay. So
say more about that.
Yeah, I mean, like, look, it's you want to fish where other people aren't fishing, right? I mean, in life, as in investing, you want to try and do something other people aren't doing. And so what's been the most out of favor sector globally for most of the last, I don't know, almost the last decade.
10
at least
years
the
now?
last
Yeah.
5 years. Yeah.
I think it's close.
Energy.
It's close to 10 years.
Energy. Look, the more people get up on their bandwagon and jump up and down about renewable energy, the more I laugh. Like, this is not trying to get political or anything, but there's just basic facts in science and chemistry that people don't understand. A human society has never gone from a more energy dense energy dense fuel to a less energy dense fuel over time. It just doesn't make sense. It's the same reason why Germany's coal consumption has gone up dramatically ever since they mandated renewables. And they made renewables, they had a mandate to, they have the highest share of renewable energy in the globe. I think it's like above 20% of their total generation is from renewable sources. And yet at the same time, their coal consumption has gone through the roof because the vast majority of renewable is not base load energy, right? You can't run a grid off renewable energy. So no matter how much solar or wind you build, you still have to build the equivalent peaking demand capable, coal-fired power plant or nat gas-fired power plant, whatever it is.
Yeah, people don't seem to get that.
Yeah, and there is a way around it, by the way. If people would actually open their eyes to nuclear, then you could do away with coal. You could you could do away with nat gas as well if you really wanted to. But for whatever reason, nuclear is seen as dirty, even though it's the cleanest of all fuels, literally zero emissions. And you can fit the amount of waste from one nuclear power plant into the size of a football field forever. You just need like 100 meters by 40 meters. But no one wants that in their backyard. And because of that, no one's building nuclear power plants, at least in the West. They're still building them in as fast as they can in China. And they're building them in the Middle East, funnily enough. But yeah, it's nuclear's persona non grata in the West, even though it is by far the most energy dense fuel we know of. And ever since Neanderthal man, climbed down from the tree and started his finger paintings in caves or whatever, we've been moving from burning dung to burning wood, to burning coal, to burning oil, and to splitting the atom. But now apparently we want to go backwards. I don't quite get it. Anyway, that's for the buy. Yeah. But the investing upshot is the necessity of fossil fuels to human progress and human society. It's not going down. It's going up. It's going up. If you get lost in the narrative that it's going down, you'll miss, I think, generational opportunities. So because there's been this huge pressure from governments, from ESG investors, from all kinds of investors to divest and or to minimize lots of fossil fuel investment, it's creating a shortage. You see this in lots of different industries. There's a massive shortage of coal, right? There's a global shortage of coal mines. And so if the cost of capital of building a new coal mine is 50% IRR or whatever, no one's going to build them. And what does that mean? That means the existing coal plants in the world have to earn extremely high returns because that's the return demanded by an investor willing to own them, right?
Yeah.
And so, look, I'm not massively long coal. I'm not super bullish on coal necessarily, but it's an example of the kinds of industries that I think are quite interesting. And there's definitely opportunities within coal, but I think oil and gas, E&P.
Are you looking at the equity or the debt?
In coal, I'm actually long some debt of a couple of companies. So I'm long some Peabody bonds, Peabody BTUs, the ticker. I wish I was along the stock. The stock's gone up like 4x in the last 2 months, maybe. But no, I'm long some bonds. I'm long some bonds because it's almost like the equity security. The equity is very, very small. There's lots of different bonds outstanding. So I won't go into too detail, but I got into these bonds in the mid 30s. They've gone up a lot since then. Look, these bonds are probably par bonds, right? So it's almost like an equity type exposure, right? If you buy a bond at 30 cents and you think you can go to par, it's almost like an equity type return, right? So,
right, yeah.
Look, Peabody's a very interesting situation, a bit of a complex situation. Elliott is involved in the equity, which nominally that isn't great for creditors when you have a very strong owner in the equity, but it's not in restructuring, right? It's still a solvent entity. They recently pushed out a huge amount of debt, meaning they have time. So if coal rallies 20, 30% and stays there, the bonds are par bonds and the stock's a $15 stock. So Peabody is very interesting. There's a lot of leverage. But no, look, there's There's a few busted type Canadian small cap copper type names I'm looking at, which I'm not really fully ready to discuss in detail because I haven't done all the work yet. But yeah, oil and gas is very interesting. That's probably an area I'd spend a lot of time. And then in terms of other general advice, I would probably say try to look outside the United States. Frankly, I think the US is a very difficult market to invest in at the moment. I mean, of course I have some investments there, but it's very expensive.
What countries do you think are most interesting right now? We're just going to call this episode the 2021 Playbook.
Okay.
Yeah.
I don't know. Anything emerging markets in general relative to the US.
Okay.
Yeah, I mean, look, I have a few Mexican investments. We can talk about my largest investment, my second largest investment, if you want.
Sure, let's do it.
Maybe there's a lot of cheap Mexican stocks, so it's not really a comment on Mexico. It's more about the business. So this company is called Betterware de Mexico. It's a multi-level marketer. It's basically
what's the ticker?
BWMX. So it's listed in the US. It's a very interesting story. It was actually the first US listed Mexican company, not ADR, native listing to the US. And it came public via a SPAC, which Mexican MLM comes public via SPAC is not normally what you send as your pitch deck to a responsible investor.
Right.
But as they say, there's always an exception that proves the rule. It's quite possibly the best business I've seen in a long time, which in itself is a little bit scary, right? Because if the business is too good, then how sustainable is it? Which is a lot of the reason why the stock is cheap, because it's earning some crazy triple-digit return on invested capital. So take it back a step. This is the Mexican Tupperware, okay? Much better than Tupperware, but essentially what they do is they sell homeware, kitchenware, house cleaning products, containers via catalog. Very recently, they moved online, but essentially they send out all these catalogs to their just two levels. Their distributors, they have 50,000 distributors, and they have 1.2 million associates. Those associates buy from the distributors buy from the company. So the relationship between the company is entirely with their distributors. So basically, it's kind of like Herbalife, right? You probably know Herbalife, where you have a downline. The company sells to one guy, that one guy sells to another guy. That other guy either uses the product or sells to their friends.
Right.
So these things are quite typically the MLM model, whether you think it's a pyramid scheme or not. And look, it's quite clear this is not a pyramid scheme because the interest in the product, the consumption of the product is extremely high. You can measure this in terms of engagement online. Twitter.
Yeah, I mean, I think the big issue with a lot of these companies is just that there's often a sleaziness or an unethical component to it.
Yes. There's a taking advantage of your network to sell them product type thing. Right, so I think what's interesting is so I guess there's two things. One, is it sustainable, and then two, is it actually that sleazy? And so Mexico is interesting because it's a very different country. It's right next to the US, but it's a very different country to the US. So first of all, it's extremely geographically and demographically dispersed. So instead of being clustered in one or two big cities or a number of major cities, which you might find in more developed countries, you have lots and lots of little communities spread over a very wide area. So actually, relationship-based selling is very common in Mexico. This isn't like the only MLM. There's like 15 different MLMs doing all, of varying degrees of success, but very common. So relationship-based selling from one community member, one family member to another is very common in Mexico, and it's not really looked down upon. So I think it is a bit different. That's a cultural difference and a geographic difference that applies in other Latin American countries as well, which means it's probably translatable. The model's translatable. The second thing that's interesting about this company is it's been around for 25 years. So it's hit a massive growth inflection recently. Obviously, COVID was a big help there, but it's not as if this is a fly-by-night operation. It's only been around for a couple of years, right? So the guys who founded it, it's a family business. They still own the bulk of the company. They haven't sold down anything, even though the stock has gone up 3x since the SPAC transaction. They pay out all their earnings as dividends, right? So, if you're going to say, well, I'm a little bit unsure how sustainable the cash flow is, they have no debt. They're paying it all out as dividends. So it's on like a 9% dividend yield on my numbers this year. It's pretty hefty, and insiders are not selling down shares, right? So, if you're looking at some of the apparent red flags or yellow flags in a business like this, first things you want to see in addition are insiders dumping shares, and or is the cash flow there? And on both those checks, they come through in spades. The other thing that's really interesting is the company. Firstly, there's the business itself, and secondly, there's kind of the narrative / technicals around it, right? So, other than the business, the interesting thing is there's no analyst coverage other than like one analyst. They, not a normal sell-sider, but basically one of these paid research firms. They haven't marketed the company at all. For the first 6-9 months, they didn't market it because they wanted to retire the SPAC warrants at a very low price, which they did. The stock's done well since then, but it still trades on 9 times, 10 times earnings. I think 9 times are my numbers, 9 times earnings for 2021, despite the fact earnings grew 150% last year. They're going to grow another 70% this year.
Wild.
Yeah. And as I said, it's paying out 80% of its earnings as div. So that's why it's like a near 10% div yield. So you have to look pretty far and wide to find a stock growing at CAGRing at, let's say 70%, at least for the next couple of years, trading at 9 times earnings, even if it is Mexico. And so the logical explanation is, one, the market thinks the returns are unsustainable. TBD, obviously, although all signs of engagement and all signs of ongoing business are extremely positive. Don't take my word for it. Look at things like YouTube views of their catalogs, right? They're going up. They put up a new catalog within, a couple of days, it has 100,000 views. Yeah. Or, things like Google Trends for Betterware de Mexico or Betterware catalog, or things like that. The level's still extremely high and much higher than they were a year ago. And Twitter engagement is extremely high. So the business seems to be doing very, very well, although it's obviously an open question how long that can go, because to be frank, they've grown massively. Like a year ago, they only had 300,000-400,000 associates. Now they have as of last quarter, they had 1.2. They're going to end the year at 1.3, 1.4, right? There's so that's a decent percentage of the adult population of Mexico, right? So obviously there's some churn in that number as well. So if you're saying, that's already a low single-digit percentage of the adult population of Mexico, it's natural to think they're bumping up against potential saturation in terms of the associate pool. The company thinks differently. The company says they're only 25% penetrated in their target markets. And those target markets tend to be what they call tier C or tier D. In other words, the lower income earners. Because look, the average price of the product at full price is $5. And then, obviously you get all these discounts through the program, right? So the distributor is not paying $5 for his product. They're paying like $2.50. And then the associate is paying $3.50, whatever. And so if the associate consumes most of the product, which I think is actually what happens, the average price is more like $3.50. So, they're going to increase their assortment so that they move slightly up market, which will increase their TAM in a sense. Mm-hmm. That's one interesting thing. But the more interesting thing is they're actually trying to develop into more of a platform. So they have this huge network of associates who distribute the product. And that's key because in Mexico, the trick is the last mile delivery. Getting the product to the warehouse is not tricky, but getting the product from that warehouse into the tiny community is very tricky. So the fact that they have this army who not only they don't have to pay, but actually pays them effectively to do it in terms of purchases, that's the real gold of the business. That's the crown jewel.
That's interesting.
And so what they're trying to do is, one, move it from a pure catalog business to online, right? So instead of having your paper catalog that you read and then you call your buddy and say, hey, I love that box. I love that mop. Can you, I'll meet you in the mall. I'll meet you in the plaza tomorrow at noon. Can you bring me 2-3 mops and, 10 containers? Mm-hmm. Instead of doing that, they just have an app. So then they order directly on the app. That app obviously geolocates who's the closest associate or the nearest one with product. So you get efficiency on inventory, whatever. Yep. And then you can just arrange a meet or pick up directly through the app. So that's point one. But I mean, the more valuable part of it is if that becomes a platform for other consumer products to, not Betterware branded, but other brands to get access to those customers. So that, then all of a sudden it becomes viewed as a platform type business, right? So then you could have this double inflection, not just in the earnings of the business, but then all of a sudden it's like, whoa, this could actually be a marketplace of sorts. Mm-hmm. an emerging marketplace, well, look at Mercado Libre, Meli. Meli trades at some crazy, and look, it's a different story, completely different model. So I'm not trying to compare the two, but even that general perception change could be worth multiples. The stock could easily multi-bag on that.
Yeah.
If it happens. And then, so then the third leg of the stool is international expansion. So they ran a pilot program in Guatemala, which is a much smaller country. But what was most interesting there was, even though it's very, very small in scale, they were making 50% EBITDA margins.
That's wild.
On a very small scale.
Yeah.
So they were basically charging a much higher price, is what I think is happening, right? So generally,
it's still really impressive.
I mean, look, it's a 60% gross margin business that translates at the moment into 30% EBITDA margins. Like, I think the margins are more like 35% EBITDA margins, but it's scaling rapidly. They were mid-20s. They were mid-20s like for most of last year, and it's like a 30% EBITDA margin business now, close enough. But it's very consistent. Like, whether, there's some FX sensitivity, but basically your gross margin is in the low 50s to 60% range. And the peso has been strengthening, right? So that's positive for them because they order their product overwhelmingly in US dollars. Most of it's made in China, and they sell it in pesos. So if the peso goes up, they do better. So look, I think you have a number of tailwinds. One, business is still firing on all cylinders. Two, the stock is extremely cheap. Three, I don't think anyone owns it because I don't think many people know about it. And I'm pretty confident in that because the daily volume is abysmal. Daily volume is like 25,000, 30,000 shares a day. So what's that? 30,000 times $30. What's that? Yeah, so it's under $1 million a day. 500,000 to $1 million a day of volume for $1 billion market cap. So that's very low, but I think it will increase over time. And look, they're going to pick up coverage. Analysts will pick up coverage, but essentially it's like Tupperware. So all the guys who cover Tupperware will start covering the stock. It's a much better version of Tupperware. There's no debt on it. Tupperware's almost died last year. And has had a crazy kind of recovery from the ashes, but it's still almost died. It's still quite levered. And Tupperware trades at like mid-teens EPS and has nothing like the growth of this guy and doesn't pay out divs. So it's like, yeah, there's a liquidity issue. There's a liquidity issue here, but then they're also pursuing a listing in Mexico as well, which who knows if that happens in the next 3 months or the next 9 months. But if that happens, look, that's incremental buyers, right? There's nothing like relisting locally to get people excited because frankly, the Better Way to Mexico brand doesn't ring on the floors of the New York Stock Exchange, but it probably does in the halls in Mexico City. So look, you have a lot of these technical type tailwinds. The business is firing on all cylinders. You're getting paid a 9-10% div and insiders aren't selling down. So yeah, on the other side, it's an EM, emerging market. Funny things happen in EM. You do have to worry about the sustainability of the system growth, not necessarily the profitability of the units, but the system probably does stop growing at some point, although they've shot the lights out every quarter as a public company. And it's a family-owned business where they still own like 40% of the company. I mean, they're in up to their eyeballs, and they have not sold down a share, which has been very interesting. So obviously in the SPAC transaction, they sold a very small piece. So they gave up basically 10% ownership of the business to do the SPAC. But also you have to understand, like doing the SPAC, they brought on board a couple of Mexican rock stars, financial rock stars, a guy called Martin Werner, who used to run Goldman LATAM banking for 20 years, which is basically like, in LATAM, in Mexico, a country like Mexico, it's who you know, right? More than more egalitarian countries, let's say. So, this guy quit Goldman after 20 years. He's also a very large investor in one of Mexico's largest banks. And the first deal he did was this company. So he would have had his pick of any deal. And the first deal he did was buying this company, well, bringing this company, backing it. And, they didn't have to list in the US. They could have listed in Mexico if they wanted to. They chose to list in the US, right? So they had bigger ambitions. So yeah, I mean, they're in bed with Mexican financial royalty. They haven't sold down. Yes, they could be a little bit better with their transparency and communication. I'm trying to help them learn what it means to be a public company in the US, but
you seem to like that role with companies.
I mean, I try to help where I can.
I like it.
And the reason is, there's an important point.
No, please.
The reason is I found a lot of the value is not actually in the business analysis. Okay. So not to say it's not hard. It's not that difficult to analyze the business most of the time. If it's an observable business, you can get your head around it, whether you're a first, second year analyst or a veteran. Analyzing the business is not the hard part. Perceiving what is going to change the market's mind about the business is the hard part.
Yeah.
Now, whether that be an inflection in the business, which is obviously harder to find than just simply understanding the key drivers, you also have to perceive the changes in those drivers. But again, I'm not even talking about the fundamentals of the business, right? Like this business was doing mid-20s EBITDA margins and has seen a huge operating expansion that I actually picked. I said, look, there's huge operating leverage in this business that people aren't appreciating because gross margins went down. So gross margins went down because the peso went down, and therefore overall operating margins were flat year on year, even though sales went up a lot for a couple of quarters last year, right?
Yeah.
But the implied operating leverage on the OPEX piece, right? So below gross profits was actually very high, but everyone missed it because the absolute operating profit didn't actually go up as much as it should have. Now that got fixed in the third quarter, and fourth quarter is going to show even more. But that part, honestly, is not even the most difficult part. The most difficult part is figuring out what the market actually cares about. The whole reason the stock went up from 20 to 30 had nothing to do with the operating leverage expansion. Nothing. It was all to do with the lack of the warrant overhang. Once that got taken out, the stock took off. In other words, these kind of technical factors, this packaging of information is often far more important than the actual fundamentals. And so that's something I increasingly try to focus on with all my investments is how can I get management to understand that it's not the business? That, a lot of managers think, oh, I'll just go focus on the business. If I keep performing, the stock will go up. Maybe, but maybe not, and might take years. And so, look, I'm not the one to say you should care about getting your stock price as high as possible now. That's not what I'm saying. What I'm saying is higher stocks create options for everyone, not just investors, but for managers. You want your company to try to maximize its value, not because you want more money, but because it gives you options. There's a reflexivity in that. A higher stock price is a currency. You can use that to grow. You can use that as a defense against being bought out, right? Especially for a family business. Maybe someone would try to buy you if the stock was still $20. If the stock's $50, then you can do what you want. You can acquire these other companies to strengthen your platform, to reinforce your dominance in that market. So it's highly reflexive. And that's the bit about capital markets that a lot of really strong business managers, I'm not saying they don't get it, but they probably don't appreciate its importance. Like we talked about Tesla before, right? I lost a lot of money shorting Tesla. Okay. I learned my lesson, but I still lost a lot of money. But if we fast forward a year, what's changed in the fundamentals? They've shipped more cars and they've lost more money. The fundamentals, the traditional fundamentals have not really changed. I mean, in grand terms, yes, they have shipped more product and they have painted pretty a lipstick on their pig of a business. But you'd be hard pressed looking at the financial statements and say much has really changed.
Right.
But what has changed is the very fact that they did not die. The very fact that they did not die when they probably should have died, when they were having a liquidity crisis, when the SEC censured them, when they were apparently weeks away from dying and they weren't paying vendors, they were stretching working cap aggressively. The very fact that they got through that flicked investors' perception such that now they are perceived as an inviolate, infallible entity. Not saying that's right, but this is the perception. They are perceived as the winner. And the very fact that they're perceived as the winner is helping them become the winner. In a similar way, this is what I try to kind of help new companies, the markets understand in some ways. Like, it's not about just going back and performing. It's about how the market like I just read an analyst report by Morgan Stanley talking about the online gaming industry.
Okay.
They had a section titled category winners. Okay. DraftKings was thrown in there.
Okay. Interesting.
Keep in mind, it's still only legal to online sports betting in about 8 or 9 US states.
Right.
Maybe more than that. Don't quote me on that, but whatever. It's some small minority of states. Okay. And within those states, DraftKings is only a market leader in a handful, really only like 3. Okay. Nevertheless, it has a crazy valuation and all the sell side is pumping it up saying these guys are going to dominate. They're a category winner. I can guarantee you DraftKings will not generate free cash flow for 5 years. I will bet a lot of money they will burn cash for 5 years and probably a lot longer. It doesn't matter. the market's decided they're a winner, so they have a much better chance of being a winner. And that's a perfect example.
Yeah. Interesting. Well, Jeremy, a lot to unpack here. We'll have you back on in a few months as 2021 unfolds and progresses. And how's your newsletter doing, by the way? I know you just curious.
It's going well.
You were just starting it last time you came on, so.
Yeah, no. Knock on wood, it's going very well. I was fortunate to have some early support, and your support is obviously most appreciated. And look, we had a very good year last year. I think on the longs, obviously the shorts were pretty disastrous. I had my worst year there ever.
Mm-hmm.
On the longs though, I think I did my year-end wrap like a week or two ago. I think I did 25 different ideas and 21 of them were profitable. So that's a very, very high hit rate. So I was very happy with that. That's probably not going to happen ever again. And the average alpha return was 40-something% on the longs. So basically what I do is I add up the return, the gross return,
Mm-hmm.
and then subtract the benchmark return. So, if the benchmark is the S&P or whatever, and the stock's up 50%, the S&P is up 20%, so that's a 30% alpha.
30% alpha.
Yeah. Again, this is from when I publish to when I exit. So obviously there might be some slippage or liquidity or whatever.
Sure.
So this isn't necessarily replicable. That's not what I'm trying to claim. But the point is, even with slippage, you
did pretty well.
Losses in there, it was a pretty exceptional year for subscribers. So I'm obviously trying to keep that going. But yeah, I'm not guiding to anything like that happening again. That was obviously, like, 2020 was an exceptional year for everyone, I think.
Especially for people that are a little bit more involved in event-driven situations and more special situations. There's a lot of interesting opportunities last year.
Absolutely. I mean, the special sit side though is honestly, the fundamental side is going to get harder to make money. I think the special sit side could stay very active, just given the amount of capital.
But I'm even considering. So let me clarify. I'm even considering special situations as, say, in March, where all you had to figure out is, will this business survive? If it does, it's a multi-bagger. Like, how many times in your life do you got to play that game?
Oh, maybe, judging by recent markets, maybe once every 10 years. But yeah, you're right. I mean, who knows? I mean,
like, to me, that was in and of itself, that was a special situation.
Right. I mean, yeah. I mean, the technical definition of a special.
I know what the technical, the bank or bank straight spinoffs or merger arbitrage or whatever. But
event driven, right?
Yeah, exactly. Yeah.
No, you're right. That was a once in a generation type.
Very unique. Yeah.
But look, there's it's a great thing about stocks. I mean, one door closes and another door opens.
There's always something new. Yeah.
I'm just trying to find that next door.
Hey, man, I'm right there with you. On that note, we'll end it. Jeremy, great to have you on, like always. And good luck with the newsletter. Good luck with I know you moved to Japan. You're in Tokyo.
Yep. Thanks.
Good luck with,
Thanks very much.
And
we'll speak again soon.
Talk to you later. Bye.